So let's talk about how it works under the hood. Okay, I'm going to get into a little bit of the technical detail here, and hopefully you guys can understand how it works. So the way to think of this is there are essentially almost two types of order books. There's what we call the internal world order book. Now, what the internal world order book is doing is it looking across all of the markets that are native to liquid. So these are not external, these are not on other exchanges. And it's looking to see if there is a match available. It's also on the back end using our multi-market orders. It's looking to see, based on FX rates or cryptocurrency rates, whether a 1, 2, 3, 4, 5 hop match is possible. And if it is, it will try to make that possible. If it's not, what it will do is it will figure out if for a given, let's use an example to make it clear. Let's say that you are a BTC SGD trader. So you are trading, you're buying and selling Bitcoin, and you are looking to buy and sell using the Singapore dollar. So what's going to happen under the hood is it's going to look at all the other BTC markets. It'll see using FX rates whether on an FX rate adjusted basis an order can be matched, and if it can be matched, it will affect that match. And then under the hood, it will do the FX transaction necessary to complete the final leg of that transaction. But as if you've read the liquid paper, you will know that's not the only thing it can do. It can also do 2, 3, and so on hops to make this possible. So at the same time, it's also going to be looking at, for example, whether an ETH market is tradable against BTC. So that's a case of a two-step transaction where it'll be taking prices from the ETH market. Let's say it's an ETH JPY market, so it's going to do an FX transaction, or it'll do an FX calculation to price that into SGD. And at the same time, it will price the base, which is ETH in this case, into BTC. And what you will see in the internal world book is that will be reflected in the SGD world book. Okay, so it can happen, for example, that you'll have traders on both sides. Imagine a case where everybody is a limit order and nobody is filled. And all that happens is that the ETH BTC rate changes. So in those cases, suddenly a large number of people could be instantly filled, because what's effectively happening is that the ETH BTC rate is allowing ETH markets to trade against BTC markets. Okay, and that's all happening under the hood, and that is all part of the internal order book. Okay, so that's all happening within our own matching engine and using our own, what we call our rates manager and a cross-currency conversion engine. Now, getting back to external, right? So what happens on the external is this. We have a piece of technology, actually a few pieces of technology, but let's sum it up and just call it the SOR. It's a little bit more than the SOR, but we'll call it that. So SOR, for those of you who do not know, means smart order routing. And what the SOR is doing is it is using the same cross-currency conversion calculations to figure out if on a given external exchange, we can affect a match between what is on our internal order book and what is on an external order book. Okay. Now, a very important point to note here, I'm going to talk about this in the slides I have, but this is kind of paramount to get your head around the whole thing. A lot of people ask us about our partnerships with other exchanges. So let me make this clear. There are two things that need to line up to make those matches happen. One of those is the prices, of course, need to be available to make the match. And when I say the prices, let me just delve in a little bit into detail about that, how we do that. We're going to look at an external order book. So let's break it back down to a very simple example here where we were talking about BTC SGD. So let's assume that there is a BTC Euro market out there. So we're going to look at the Euro to SGD FX rate, and we will reprice what is available externally in the BTC Euro market into what is into SGD. And if a match between those two can be made, what will happen is that QUOINE will act as the counterparty on both sides of that trade. So this is something I'd like a lot of people to understand. Get a lot of questions about this, and maybe we'll talk a little bit more if people want to understand a little bit more about what we mean by ECNs and DMA and all that kind of stuff. But what I want you to understand here is that what is effectively happening under the hood is that QUOINE is trading on an external exchange on behalf of the client. They are effecting a match against a client on some external exchange, and they are effecting the same match on our exchange. And we are passing on those two. We're matching them up. So if in the case of the BTC SGD trader, if they were selling BTC, what would happen is that we would be buying on this external exchange with euro. So we would receive these Bitcoin. Of course, we wouldn't immediately receive them from the exchange, but we would effect that match, and we would be delivering those BTC to the person selling. We would receive from the person selling SGD, and we would then take that SGD, possibly in real time. There are cases where we might not do it in real time, and turn that into euros, right? So that's essentially how that all works. Now, what I would like everyone to understand is, I mentioned there were 2 points to this. One was the price matchup. So the price is, of course, FX adjusted, and it's also fee adjusted. So let me understand what I mean by fee adjusted here. Of course, on the external exchanges, we have to pay fees. Now, because we are trading extensively, and because in the future with the external world book, we'll be trading even more, we enjoy extremely low FX transaction rates or transaction rates, fees. And to give you an example, on any of the major crypto exchanges that we trade on, and we trade on almost all of them that you would know of, certainly all of the major ones, we currently receive best transaction fees for those exchanges, or in some cases better. Okay, so you cannot get necessarily as an individual the exchange costs that we are getting. The second thing that we do there to make that match is we do an impact adjustment, because we do have to protect ourselves and we do have to worry about the transaction risk. So in a highly volatile market, there may be a price that matches your price, but if the markets are moving extremely swiftly, we may adjust those prices for volatility. Okay, so that's all about how we would make the match on the pricing side. But I mentioned there's a second and very, very important point, and that is our external capital capacity at a given exchange. And a very big portion of what we're doing this year has to do with enhancing that. So as I mentioned, I'm going to talk about that in a moment. So what does that mean? Well, let's say that on a given exchange that we put, $30 million on that exchange. Well, if we have no credit facilities or anything, then we have purchasing power up to $30 million of fiat. And conversely, we would have something similar if we had Bitcoin or Ethereum or whatever we may have on that exchange. So in its most simplest form, we're going to be limited by price availability and by our own available capital. So to answer your question, go back more significantly, will you get the best prices? Yes, if two criteria line up. One, the best prices are on an impact and fee adjusted basis and FX adjusted basis available. And two, if we have the capital to affect the trade.